Hi, and welcome back to the Food Fund, where we explore all things related to investing in food and beverage stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in great companies. If you love food and love stocks, you will definitely love this channel. In this video we will be doing an analysis of Pepsi and seeing if it would be a great addition to the Food Fund. Be sure to watch through the end of the video where I share my final thoughts on that. Before we get started, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the Food Fund. Now, cue the logo. Starting with the 1-year chart, we see that Pepsi had a CAGR of about 7.5%. Zooming out to the 5-year chart, we see that Pepsi had a CAGR of 13.6%. This is an excellent return. Now, let's take a look at the fundamentals. Gross margin is strong at 53%. Revenue has compounded at around 8% over the past 5 years and has topped $88 billion on a trailing 12-month basis. Good revenue growth and strong gross margin makes for a very attractive investment. Looking at free cash flow, we see in -3% CAGR over the last 5 years, while capex has increased at a CAGR of 12% and stock-based compensation increased at a 8% CAGR. With diminishing free cash flow and growing capex, Pepsi appears to be investing in their infrastructure. While all companies go through similar investment cycles, it would have been better to see this capex during the lower interest rate environment and tapering off now that rates are much higher. Stock-based compensation is so small that it is negligible next to free cash flow. Next, weighted average shares outstanding have actually been trailing downwards, revealing that Pepsi is actively buying back shares when the company is undervalued. I really like this and will look forward to Pepsi repurchasing even more shares in the coming years. Now let's view my favorite metric, return on invested capital. Return on invested capital has fallen from 18% in 2018 to 13% most recently. This is the exact opposite of what we want to see. I wonder what is driving this decline in efficiency? Another favorite metric is cash conversion cycle, a measure of operational efficiency at the company. Going from -10 days in 2018 to -135 days most recently, Pepsi is demonstrating improving leverage. For those who are new to the channel, a negative cash conversion cycle means that a company's inventory is sold before they have to pay suppliers for the materials to make product. Seeing this gives me more comfort, as it means the operational side of the business is continuing to improve in efficiency. This reassures me that the falling free cash flow is primarily due to capex spending and should rebound once Pepsi completes their investment cycle. Last, let's explore Pepsi's debt metrics. We will be looking at the current ratio, the debt to equity ratio, and the net debt to EBITDA ratio as we defined those terms in a recent video. For Pepsi, the current ratio is 0.9, the debt to equity ratio is 0.8, and the net debt to EBITDA ratio is 3. The fundamentals of Pepsi seem strong, though it would be great to see them move on from their investment cycle. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please subscribe, like, and share this video. Your support means a lot to the Food Fund and your continued viewership is a huge help to grow the channel. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Pepsi. It is a beverage company with a gross margin of 53%. Good start so far. The 5-year revenue per share CAGR is 7% and the 5-year free cash flow per share CAGR is -2.7%. This is not ideal but seems to be a market-wide trend. A Wall Street Journal article from last year highlights that more companies are in their investment cycle. Still, I would prefer Pepsi make these huge capex investments at better strategic times. A return on invested capital of 13% is pretty good, but Pepsi had been doing 18%, so I do not like that we are on a downtrend. Next, the cash conversion cycle of 135 days is pretty good, no complaints there. Concerning debt, a net debt to EBITDA of 3 means the company can pay off its debts with 3 years of EBITDA. Very nice. So from a fundamental standpoint, Pepsi is good but could be stronger. Now let's switch our attention over to valuation. Pepsi is overvalued relative to the S&P 500 with a ratio of 1.8. Again, good companies often trade at a premium to the market, but Pepsi, at its all-time high, is a bit too rich. The price to earnings growth, or PEG ratio, of 3.3 reinforces that Pepsi may be a bit too expensive right now relative to its projected earnings growth. To wrap it all up, Pepsi is a great company with strong growth prospects. However, its capex spending and high valuation are a little dissuading at the moment. Let's put it on the watch list and see what else is out there. Many thanks for watching. What do you think about Pepsi and its valuation? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.